Your bank is currently lending your savings to someone else at 7 times the interest rate they're paying you, and they would very much prefer you didn't notice. But here's the part that doesn't make the headlines. At exactly $50,000 in savings, something specific shifts not metaphorically, mechanically. And banks have internal customer models that predict your next move before you've made it. I've spent 3 months cross-referencing FDIC call reports, Federal Reserve consumer finance surveys, and the annual reports of 3 major retail banks so we can have this conversation with actual numbers instead of vibes. What I want to do in this video is walk you through 4 distinct mechanisms by which saving $50,000 changes your relationship with a bank, and not in the way most personal finance content describes. This isn't about hidden fees or fine print. It's about incentive structures, about how the entire retail banking business model was built around a customer who is slightly behind, slightly anxious, and slightly too distracted to comparison shop. And what happens to that model when you stop being slightly anything? This is genuinely strange when you look at it clearly. It is also genuinely predictable once you understand what banks are optimizing for, which turns out to be not your financial health. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They use assumptions that Vanguard and BlackRock internal teams would find embarrassing. It uses real methodology to expose the weak points in your plan. And I only ask for your email to send the report, so I don't store any of your financial data. Link is in the description. Here's the metaphor I keep coming back to, and I'm going to use it throughout this whole video because it explains the mechanics more cleanly than most textbooks do. Think about a hotel. Not a luxury hotel, a mid-range hotel, in a city with 2 other mid-range hotels on the same block. The hotel makes money as long as you stay. Every night you're in that room, they're billing you. The minibar is $12 for a water bottle. There's a resort fee on your checkout receipt that nobody mentioned at check-in. A parking charge that appeared without warning. They are perfectly happy for you to be slightly uncomfortable, slightly disoriented, slightly unsure whether the alternatives are actually better because that uncertainty keeps you in the room. But the moment you figure out that the hotel down the street is 30% cheaper and has free parking, the front desk suddenly becomes very attentive. There are upgrade offers, the manager wants to speak with you. That's a bank with your savings account. And $50,000 is roughly the point where you start checking out other hotels. I'm going to return to this hotel throughout the video. It's going to show up in places you don't expect. In a few minutes, I'm going to show you something about the regulatory architecture around your bank account that most people assume is protective, but is quietly working against them at the worst possible moment. But first, let me show you exactly how much money your bank is extracting from your savings right now, because the number is more precise than you think, and it reframes everything about why they behave the way they do. The average yield on a standard savings account at a major US bank, Bank of America, Wells Fargo, Chase sat somewhere between 0.01 and 0.5% in early 2026. I'm going to be generous and call it 0.5%. On $50,000, that's $250 a year. That's what they're paying you. Now let's look at what they're earning. Your bank takes your deposit, bundles it with every other depositor's money, and puts it to work. A 30-year fixed mortgage is currently around 6.8%. A personal loan runs 8 to 12%. A credit card charges between 20 and 29.9 to 9%. An auto loan is sitting around 7%. The spread between what they pay you and what they charge borrowers is called the net interest margin. For the largest US banks, that averaged around 2.8% across the whole balance sheet in 2025. On credit cards specifically, that margin balloons to 15 to 25 percentage points. That minibar in the hotel costs $12 for a water bottle. The bank's version of the minibar is your revolving credit card balance. Here's where the $50,000 figure specifically enters the picture. Below that level, most customers are what the industry internally calls rate insensitive. They're not comparison shopping. A 2023 Consumer Financial Protection Bureau survey found that over 60% of Americans with savings accounts had never compared their interest rate to a competitor. Not once. And honestly, when your balance is $8,000, The difference between 0.5% and 4.8% is about $340 a year. That's real money. But it's not open a browser, fill out another account application, wait for microdeposits to verify money for most people under the daily pressure of normal life. At $50,000, that exact same rate differential is $2,150 per year. That's a car payment. That's a vacation. That's the number that starts appearing in your mental math when you try to figure out why your savings balance isn't doing anything interesting despite 5 years of disciplined contribution. And here's the reversal you didn't see coming. You probably think the problem is that banks are greedy. They're not especially greedy, they're rational. Every institution in a competitive market charges what customers will accept. The actual problem is that for most of your adult life, you've been the exact right size to be perfectly profitable and perfectly inert. The moment your balance grows large enough that you actually feel the rate differential in your real bank statement, not as an abstraction, but as a number with a comma in it, you become a flight risk. And your bank knows this before you consciously do. This isn't speculation. Banks run customer segmentation models as a core business function. Their retention data shows them that customers crossing the $50,000 savings threshold are materially more likely to open brokerage accounts, move money to high-yield alternatives, and reduce the depth of their banking relationship within the following 18 months. Their own research predicts your departure. They just bet correctly, most of the time, that you won't execute it quickly enough to matter. There's a man named Gerald who ran a dry cleaning business in Dayton, Ohio for 22 years. He never had more than $12,000 saved at any one time because he kept reinvesting new equipment, a second location that didn't survive 2009, rebuilding from scratch. Then, his landlord sold the building he'd operated out of for 3 decades. The new landlord raised rent 60%. Gerald sold the equipment, walked away from the lease, and deposited $68,000 in his checking account. First time in his adult life, he had money that wasn't working, wasn't in motion, wasn't already spoken for. For 3 months, Gerald did absolutely nothing. The money sat there, earning approximately zero, while his bank offered him, in sequence, a home equity line of credit on his paid-off house, a premium rewards credit card that required $700 in annual spend to justify its benefits, and a pitch for their wealth management division managed mutual funds with an average expense ratio of 1.2% per year. Gerald nearly took the wealth management pitch. The banker was professional, used confident language, had a clean office with a plant in the corner. But Gerald's son-in-law, who works in software and watches finance content, pointed out that a 1.2% annual fee on $68,000, assuming 6% growth over 20 years, would cost Gerald approximately $41,000 in returns he would never see. Not in fees, that number sounds small when you annualize it. In compounding, that would have grown on top of the fee amount, but couldn't because the fee took it first. Gerald opened a Fidelity account the following week. He put the money in a total market index fund with an expense ratio of 0.03%. He is now earning market returns minus essentially nothing. His bank lost $68,000 in assets under management and replaced it with nothing. The hotel lost a guest who finally checked the price of the hotel down the street. Stay with me, because this next part changes the entire framing of why $50,000 is specifically the relevant number. Not $40,000, not $100,000. It has to do with how debt functions as a product and what happens economically when a customer can credibly opt out of it. In 2023, the Federal Reserve Bank of New York published data showing American households collectively held around $1.13 trillion in credit card debt. The average interest rate on that debt was 21.5%. That number is not an accident of market forces. It is a price point that has been tested, adjusted, and legally upheld over decades by people whose entire professional purpose is to find the maximum charge rate before customers either default or stop borrowing. JP Morgan Chase's card services division earned over $15 billion in net income in 2024. Not revenue, net income. From credit cards, from interest and fees collected on money lent to people who needed something now and couldn't wait. The average person with less than $25,000 in liquid savings has almost no practical alternative to debt for large unplanned expenses. Car engine fails, finance a replacement. Medical bill hits, payment plan at interest. Refrigerator dies, store credit card at 24%. The bank isn't being predatory in a mustache-twirling sense. It's filling a real gap in a real moment of need. It just fills that gap very profitably, and at terms that are optimal for the bank rather than the borrower. At $50,000 saved, that changes in a concrete way. You can buy a used car for cash. You can absorb a $3,000 medical bill without going to collections. You can wait for a sale rather than financing immediately because the thing failed today and you need it today. The urgency that makes people accept structurally bad financial terms begins to dissolve. Not completely urgency is always psychological as well as financial, but enough to shift behavior. There's a body of academic research on exactly this dynamic. A study published in the Journal of Consumer Research found that financial scarcity, not poverty specifically, but the cognitive state of having too little relative to your perceived needs, causes systematically worse financial decision making. Not because people under financial stress are less intelligent, because the mental bandwidth required to manage scarcity actively reduces the cognitive capacity available for long-term thinking. The researchers called it the bandwidth tax. Every dollar of mental energy going toward how do I cover this month is a dollar not going toward what is this decision costing me over 3 years. $50,000 is roughly where the bandwidth tax starts to lift, where you stop deciding under urgency and start deciding under strategy, where you stop being the person who finances the appliance on the store card and start being the person who bought an extended warranty with cash 2 years ago because you had the liquidity to plan that far ahead. Banks need the urgency. The urgency is their product. The 21% credit card margin exists because of urgency. And when you accumulate enough savings to eliminate urgency from your financial decisions, you become, from the bank's perspective, a significantly less monetizable customer relationship. Now here's a second thing that happens at $50,000 that most people don't anticipate. You become practically eligible for the alternatives that actually compete with banks for your money. Treasury bills purchased directly through treasurydirect.gov were yielding around 4.3% in early 2026. Vanguard's Federal Money Market Fund, ticker VMFXX, was yielding approximately 4.2%. A high-yield savings account at one of several online banks was paying between 4 and 5%. All of these are available to anyone. But below roughly $20,000 to $30,000, the administrative friction of managing multiple accounts tends to outweigh the benefit. At $50,000, the math flips. On $50,000, the spread between a standard bank savings account at 0.5% and a treasury bill at 4.3% is $1,900 per year, not theoretical, not adjusted for some unlikely scenario. $1,900 per year that you are currently leaving on the table if your money is in the wrong place. Here's something most people don't understand about how deposit rates work and why they move so slowly. There's a concept called deposit beta. It measures how much of a central bank rate increase a bank passes through to depositors. During the Federal Reserve's rate hiking cycle, between 2022 and 2023, one of the fastest rate increases in modern history, the major retail banks passed through approximately 15 to 20 cents of every dollar of rate increase to their deposit customers. Meanwhile, they immediately repriced their loans upward. They widened their margins dramatically during that period, and the people sitting in standard savings accounts never saw most of it. By contrast, when the Fed started cutting rates in 2024, those same banks repriced their savings offerings downward much faster. The asymmetry is notable. Rate hikes, slow to pass through. Rate cuts, fast to implement. This is not a conspiracy. It's just the rational behavior of a business with pricing power over customers who aren't shopping around. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. I want to introduce a secondary thread here because it connects to something in the third section that changes how you should think about all of this. There's a guy named David, mid-40s, works in supply chain management, has been accumulating money steadily for 6 years by driving a paid-off car, avoiding restaurants 4 nights a week, and banking his annual bonus instead of spending it. He's built up $53,000 across 2 savings accounts. David is not wealthy, but David is, for the first time in his adult life, genuinely liquid. David started moving his money based on some research he did. $40,000 into a high-yield savings account, a chunk into 3-month treasury bills. He canceled a premium credit card he'd been paying $95 a year for rewards points he never redeemed. He started asking for cash prices when hiring contractors. His bank noticed, not through any targeted surveillance, through completely normal business logic. His average daily balance dropped. His credit card activity flatlined. His loan activity was 0. From the bank's revenue model, David went from being a moderately profitable customer to being nearly invisible. He still had an account there. He was using it as a pass-through for direct deposit. That was it. I'm going to come back to David. Because what happened next is something that a lot of people with growing savings balances genuinely haven't anticipated, and it connects to the next section in a way that might surprise you. Here's what nobody is telling you about the regulatory layer underneath your bank account. And I want to be precise here because this is the section that gets distorted the most in online finance content, usually in the direction of paranoia that's more emotionally satisfying than useful. The Bank Secrecy Act was passed in 1970. It requires financial institutions to assist government agencies in detecting and preventing money laundering and financial crimes. The practical mechanisms are 2. Banks must file a currency transaction report for any cash transaction deposit or withdrawal exceeding $10,000. And they must file suspicious activity reports for transactions that appear unusual relative to a customer's account history, regardless of dollar amount. In 2023, U.S. financial institutions filed approximately 3.6 million suspicious activity reports with the Financial Crimes Enforcement Network, known as FinCEN. 3.6 million reports in a year. For context, there are hundreds of millions of individual bank accounts in the United States. The filing rate is statistically low, but the selection is not random. It's algorithmic. The models banks use to flag anomalous activity are calibrated against your individual account history. If your account has carried an average balance of $4,000 for 3 years, and you suddenly deposit $52,000 from a home sale, a business transaction, or an inheritance, the algorithm flags it. Not because you did anything wrong, because the pattern diverges sharply from your established profile. A compliance officer reviews it, typically concludes within a short time that there's nothing suspicious, and moves on. The flag is cleared. In the vast majority of cases, nothing further happens. But here's where it actually creates friction in the real world. The structuring statute, part of the same regulatory framework, makes it illegal to deliberately break up transactions in order to stay below the $10,000 reporting threshold. So if someone makes deposits of $9,800, then $8,900, then $9,400 over a short period, that pattern itself triggers a structuring suspicious activity report regardless of the total amount. The attempt to avoid reporting is defined as the crime, independent of whether the underlying funds had any criminal origin. This creates a genuinely uncomfortable situation. The fully legal behavior, depositing a large lump sum, can generate a compliance review. The intuitive attempt to avoid that friction, smaller sequential deposits, is itself a federal violation. Most people have no idea this asymmetry exists until they're inside it. Let me tell you about Sandra. She sold her jewelry business in 2023, a small operation she'd built over 15 years. Genuinely profitable, genuinely legitimate, and received the purchase price in a wire transfer, $228,000. She deposited it into her existing personal checking account at a national bank where she'd been a customer for 11 years. She planned to figure out what to do with it over the following weeks. Within 4 days, her account was restricted. Transfers above $1,000 were blocked. Wire requests were declined. She received a secure message from the bank's compliance team requesting documentation of the source of funds, a purchase agreement, a closing statement, verification of the transaction. Sandra had all of it. She uploaded the documents. The review took 48 hours. The account was fully restored. But those 48 hours fell across a contractor payroll obligation and a mortgage payment. Sandra couldn't make either. She had to call the contractor, someone she'd worked with for years, and explain that her bank was temporarily restricting her account. The mortgage payment was late, triggering a grace period notice from her lender. No lasting damage. No late fees, technically, because she paid within the grace window. But for 2 days, Sandra sat in her house, unable to access $228,000 of money she had legitimately earned, legally received, and legally deposited. The compliance system worked precisely as designed. An anomalous deposit was flagged, documentation was requested, the flag was cleared. Sandra was not a criminal. The bank was not her enemy. But the system that exists to protect the financial infrastructure from illicit actors briefly made Sandra's life significantly worse for no practical benefit to anyone. The hotel installed security cameras to catch theft. The cameras make every guest feel slightly surveilled. The actual thieves know where the blind spots are. The practical upside from Sandra's experience, if you're approaching a similar transaction, initiate it as a wire transfer, not a cash deposit. Wire transfers come with a built-in paper trail, the sending institution, the account, the stated purpose. Prepare your documentation before the deposit, not after. Sale agreement, closing statement, probate filing, whatever applies. Don't structure. Be boring and obvious. The compliance architecture does not care about boring and obvious. It cares about unusual patterns. And the most effective response to pattern recognition systems is to make your pattern completely legible. David is back, the supply chain guy who moved his $53,000 and became nearly invisible to his bank. After reducing his balance and eliminating his credit card usage, David's bank sent him a series of promotional offers over the next 4 months. A balance transfer card at 0% for 15 months. David had no balances to transfer. A home equity line of credit at a competitive variable rate. David doesn't own his home. A premium checking account with enhanced benefits at $25 per month, replacing the free checking account he'd held since 2011. He ignored all three. But the sequence is revealing. When a customer's behavior stops fitting the profitable profile, the bank doesn't accept the loss. It attempts to re-engineer the relationship back into a profitable configuration. The offers aren't random. They're targeted efforts to rebuild a debt or fee relationship that David had inadvertently exited by becoming financially literate enough to use the existing system correctly. Now, I want to get into the deepest layer of this because I think it's the most actionable and the most consistently overlooked in mainstream financial content. There is a robust body of behavioral economics research originating with Daniel Kahneman and Amos Tversky in the 70s and 80s, significantly extended since, on how financial stress reshapes decision-making in ways the person under stress cannot easily perceive from inside the experience. We already talked about the bandwidth tax from scarcity. There's a related and distinct mechanism called present bias, the tendency to weight immediate outcomes disproportionately relative to future ones. People experiencing financial stress are measurably more present biased than people who have accumulated a financial buffer. When you're stressed about covering this month, the concrete relief of having the thing now overwhelms the abstract cost of interest you'll pay over 18 months. Not because you're irrational, because your brain is solving for the immediate problem with the tools it has. Banks profit structurally from present bias. Nearly every fee-generating product in retail banking is optimized for a customer whose present feels urgent and whose future feels theoretical. The credit card with the 18-month 0% intro rate exists to capture people who intend to pay it off before interest kicks in, but statistically don't, because the future keeps becoming the present and the urgency keeps winning. At $50,000 in savings, your relationship with time changes in a measurable way. Future, you, becomes more concrete. Interest accumulating over 36 months becomes something you calculate rather than avoid thinking about. You start paying attention to compounding not as a concept from a book you read once, but as something your actual money is doing or not doing right now in your actual account. The future has stakes you can see. There's also a psychological phenomenon called mental accounting, the tendency to treat different categories of money as distinct even when they're functionally interchangeable. People who keep savings and spending in the same checking account are more likely to spend the savings than people who physically separate them into distinct accounts. At $50,000, the sum is large enough that people almost universally start separating mentally, which creates the behavioral precondition for actually separating institutionally moving money to dedicated vehicles with different access friction, different yield profiles, different psychological identities. This is the deepest level of the $50,000 threshold. It's not about the number per se, it's about what that number does to the operating psychology of the person who has it. Below it, most people are managing scarcity. The bandwidth tax is running. Present bias is winning most decisions. Above it, people begin managing strategy. And every part of the retail banking product stack is significantly better at extracting profit from scarcity managers than from strategy managers. The bank's most profitable customer is the one who is always slightly behind, always slightly stressed, always choosing the option that provides immediate relief rather than the option that's mathematically correct. That's not a moral judgment. That's a description of how human psychology interacts with financial pressure. And banks have spent decades and billions of dollars engineering products precisely for that psychological profile. And here's what ties all four of these threads together in a way that's more uncomfortable than any single piece. The $50,000 threshold doesn't appear in any bank document. There is no internal policy that says alert at $50,000. What happens at that level is the simultaneous convergence of four independent mechanisms. The interest rate differential becomes large enough to motivate behavioral change. The debt exit becomes practically executable. The compliance architecture becomes relevant in new ways, and the psychological shift from scarcity to strategy begins. None of these were designed as a coordinated system targeting you specifically. They emerged from different regulatory, economic, and behavioral origins and happen to converge at roughly the same balance level, which makes the combined effect more durable than any single policy and far harder to identify until you're already inside it. Somewhere a bank product manager just read the phrase convergence of independent mechanisms and is adding it to a PowerPoint called deepening the customer relationship. The relationship they're describing is yours with their fee structure. The plant in the corner of the office is doing great. Let me make this specific with one scenario that could be almost any viewer's situation. Call him Ryan. 38 years old, project manager at a mid-sized construction firm in Phoenix, Arizona. Annual income of $94,000. Paid off car. A mortgage with $140,000 remaining at 4.1%. No credit card debt. 5 years of disciplined saving, maxing his 401k employer match. Cutting discretionary spending. Banking, his annual side consulting income has produced $51,000 sitting in a standard savings account, earning 0.45% annually. On $51,000 at 0.45%, Ryan earns $229.50 per year. That is what his bank is paying him. Meanwhile, using a conservative estimate of that bank's net interest margin, the bank is earning approximately $1,420 per year from Ryan's deposits. Ryan earns $230. His bank earns $1,400 from his money. These numbers are not contested. They're in the public filings. Ryan takes 2 hours one Saturday morning. He moves $40,000 to a high-yield savings account at 5%. Yes, these still exist in early 2026. You have to look for them, but they're there. He keeps $11,000 in his checking account for operating expenses and 3 months of emergency coverage. He opens a Treasury Direct account and sets up automatic 4-week Treasury bill purchases with any month-end surplus above his $11,000 floor. He calls his bank to ask if they have a competitive rate for his balance tier. They don't. He thanks them and hangs up without drama. After those 2 hours, Ryan is earning approximately $2,000 per year in interest instead of $229. The difference is $1,770 annually. Over 10 years, holding the balance roughly constant and assuming rates in the 4 to 5% range, which is a conservative assumption, not a guarantee, that's $17,700 in additional interest income he would have permanently forfeited had he not acted. But now Ryan notices something interesting. His mortgage interest rate is 4.1%. His savings are earning 5%. This means Ryan should not aggressively prepay his mortgage. The mathematical return on every dollar he keeps liquid and earning 5% is higher than the 4.1% he saves by reducing the mortgage principal. This runs directly counter to what most people's intuition says about eliminating debt. 3 years ago, when savings rates were near zero and his mortgage was the same 4.1%, the math pointed the other way. Today, it doesn't. The environment changed. The correct answer changed. Nobody from his bank called to tell him. Ryan then opens his 401k portal and looks at two numbers he's never examined: current expense ratios and default fund allocations. He finds that his employer defaulted him at enrollment into a target date fund with an expense ratio of 0.7% and an actively managed large cap equity fund with an expense ratio of 1.1%. He reallocates both into a total market index fund with an expense ratio of 0.03%. The difference between 0.03% and 1.1% on $80,000 in his 401k, growing at 7% annually over 25 years, is approximately $116,000. Not in fees he pays out of pocket. In compounding returns that would have grown on top of the fee amount, but couldn't because the fee extracted them first every year before he ever saw them. Ryan was donating $116,000 to a fund manager who was, statistically speaking, almost certainly underperforming the index he was benchmarked against. The fund didn't hide this. The expense ratio was disclosed. Nobody highlighted it at enrollment. Ryan spent 2 hours. He kept his bank account. He didn't get rich in an afternoon. He stopped being optimally extracted from, which is not the same thing as getting rich, but is the necessary precondition for it. David, meanwhile, resolved his story simply. He moved his money, reduced his bank to a pass-through checking utility, opened a brokerage account, and started building a position in a low-cost index fund. His bank eventually offered to downgrade him from a premium checking account to a basic account with no monthly fee. David accepted. He now pays his bank nothing per month. His bank earns essentially nothing from him. And David is, for the first time in his adult financial life, on the right side of the interest rate equation, earning rather than paying. But here's what David told me when I asked him what the experience actually felt like. He said the most disorienting part was realizing that the financial system he'd been embedded in for 20 years was not designed for him. It was designed for a version of him who was slightly behind, slightly anxious, slightly unlikely to spend a Saturday morning reading about treasury bills. The moment he spent that Saturday morning, the architecture became visible. And once you can see the architecture, you can't unsee it. The hotel metaphor collapses into something real. You're not a guest, you're inventory. Let's come back to where we started. Your bank is lending your savings at 7 times the rate they're paying you. At $50,000, that spread is not a rounding error. It is a number with a comma in it every year that you are either keeping or donating. 3 practical takeaways. These are calibrated specifically to having $50,000, not to generic personal finance advice. 1. Keep 3 months of operating expenses at your current bank, not for sentimental reasons, but because wire transfers and ACH take 1 to 3 business days, and you need real-time liquidity for day-to-day needs. Everything above that 3-month buffer should not be in a standard savings account. The mental model is simple. Your bank is a checking utility. It is not a savings vehicle. Every dollar above the operating buffer, earning 0.5% instead of 4+%, is a dollar you are actively choosing to donate to the bank's net interest margin. The hotel analogy is useful here. You don't live in the hotel. You check in when you need to and leave when you're done. 2, open your 401k and find 2 numbers: your current expense ratios and your employer default fund allocations. If you were enrolled automatically, which most people are, you are almost certainly in funds with higher expense ratios than the cheapest available options in your plan. On $100,000, growing at 7% over 30 years, the difference between 0.03% and 0.8% in annual fees is $116,000 in compounding returns. You will never see, if you do not look, That is not a number I'm approximating loosely. I ran it with a standard compound growth formula, and I'd encourage you to verify it. 2 clicks to reallocate. Almost nobody does it because nobody explained that the default choice was expensive. 3. The next time you're facing a significant purchase, contract, or work, a car, a renovation, ask for the cash price before you ask about financing. This is almost never practiced, even by people who know they should do it. Vendors, dealers, and contractors all build margin into their pricing to cover the cost and friction of financing arrangements. That margin belongs to you if you're paying cash with a wire transfer in 5 business days. The $50,000 savings balance is not a passive accomplishment to feel good about. It is negotiating leverage. Every dollar you have in liquid savings is a dollar that can accelerate a transaction for the other party, and people pay in the form of discounts for that acceleration. Lazy investing built more fortune than crypto memes. David's Bank, by the way, reported record net income last quarter. The system is working exactly as it was designed to work. The only open question is which side of it you're operating.